Hey everybody, it's Renee Hoos with Spire Mortgage Team with our October mortgage update. There have been more changes in the last month in the Canadian mortgage market than we have seen in total since 2016. So we have a lot of stuff to discuss today. We've probably got a 10-minute video, but a lot of these things could affect you both if you are a purchaser or if you have a mortgage renewing or if you are a realtor in this market because you want to have this information for your client. The first thing that we're going to talk about today is the changes to the 30-year amortization rules. Effective December 15th, first-time homebuyers are going to be able to obtain 30-year amortization on any property type. So currently, first-time homebuyers can get a 30-year amortization if they're buying a new build, but that is going to be extended to all property types effective December 15th. So if you're buying a $500,000 home, that means that your payments are about $200,000 cheaper now per month if you take that 30-year amortization. So it's adding a little bit more affordability back into the pocket of buyers. It also means that buyers can qualify for a little bit more. You might be able to qualify to finish that basement or add on that garage, those types of things to your mortgage. Certainly a really great opportunity for first-time home buyers. In addition, now all home buyers, whether they're first-time home buyers, second-time home buyers, or 100th time home buyers, will be able to obtain 30-year amortization on new build properties with less than 20% down. So that's awesome. Really a way to initiate more building in that Canadian market. These are really supply-related changes that we're seeing in the market. The Canadian government really wants to see builders building more homes. We should take a minute to talk about what is a first-time home buyer. So a first-time home buyer is anyone that has not resided in a property that they own in the last 4 years, okay? So if you bought a rental property 8 years ago and you've never lived in it, you are still considered a first-time homebuyer because you never resided in that property. First-time homebuyers are also people that have recently experienced marital or common law relationship breakdown. So if you've recently gone through a divorce or split from a common law partner, you are automatically eligible to be treated as a first-time homebuyer again. So that means you can buy a property with less than 20% down and obtain that 30-year amortization. Just a quick reminder that you don't have to be a first-time homebuyer to buy a property with less than 20% down. But if you want the 30-year amortization on a resale home, you do have to qualify as a first-time home buyer. So lots of rule changes, and it's important to reach out and find out exactly what category you fit into. The next big change to talk about is the price cap for insured mortgages. So historically, the price cap for an insured mortgage, that means a property you can buy with less than 20% down, was $1 million, okay? If the purchase price was $1 million, you needed 20%, and if the purchase price was $999, you could do it with about 7.5%. Now, that price cap has been increased to $1.5 million. That means that anybody that is purchasing a home up to $1.5 million can purchase it with as little as $125,000 down payment, if you qualify, of course. It's important to note that the default mortgage insurance premiums are quite hefty at that rate. They're about $50,000. So you'd really want to have an idea of what you were going to do with those funds otherwise. We heard these 3 big changes and we thought, my gosh, that must be it for the month of September. But later in the month, we heard that effective November 21st, there will no longer be a stress test for uninsured mortgages. This brings more competition back to the mortgage market, which is awesome. So if you have a mortgage coming up for renewal that had a 30-year amortization, maybe still has 28 years left on it, that mortgage does not have to be stress tested when we move it to a new lender. It means that you are more likely to enter the mortgage market again and obtain the most competitive rates for your mortgage at renewal. There are a lot of Canadians that really felt that their hands were tied this year and they couldn't switch lenders at renewal, so they very much had to be price takers. If you have a mortgage coming up for renewal, we always encourage our clients not to sign on the dotted line because there's usually a better opportunity out there. And even if you don't switch lenders, it's at least great negotiating power with your current lender to know what's available for your mortgage. mortgage. We're still waiting for some clarity in the market about insurable mortgages. So those are mortgages with 25-year amortization or less, and they were properties up to $1 million or less, but now they're likely to be properties up to $1.5 million or less. Right now, the government is not including insurable mortgages in these new pricing changes, but we expect that there might be some changes. So stay tuned for some changes for better mortgage pricing for mortgages or property prices over $1 million up to $1.5 million, and also some great renewal opportunities in those price points as well. Stay tuned, no clarity yet, but we expect to have that in our November update. 5-year Government of Canada bond yields continue to be incredibly volatile. Earlier this week, we had a very aggressive job report out of the United States, and we saw the 10-year Treasury yield take off. So government bond yields in Canada are up almost 25 basis points this week. We still have some very aggressive fixed price offers, but if you are shopping and counting on a fixed rate mortgage, it's important to note that you probably want a rate hold. Rates are trending down, but we are going to see a bit of a jagged graph as those rates move down, because we're going to hear some inflationary or scary data out of the States or out of Canada every couple of weeks that might send our bond yield in our bond market, I should say, into a bit of a frenzy. So fixed rates, again, trending down, but it is not going to be a perfectly straight line curve. It is going to be volatile as we trend towards the bottom. The big decision that clients are having to make right now is, should I take a variable rate mortgage or should I take a fixed rate mortgage? We have insured fixed rate mortgages, in some cases as low as 4.09% effective this morning. Reminder that insured means less than 20% down payment. We have mortgages with more than 20% down payment, kind of between about 4.19 and 4.54, depending on the type of product and lender that you are looking for, and depending on how large your down payment is. Variable rates are much higher because our bank prime is still sitting at 6.45. So if you have a rate of prime -1, that means your starting point on a variable rate mortgage is about 5.5%. If you can obtain a fixed rate mortgage at 4% and take that bird in hand, we are starting to encourage clients to think about that as an opportunity. When we look at all of the analysts and all of the journaling and all of the graphs out there in the market, we're seeing fixed rates bottoming just below 4%. So we aren't sure that it makes a lot of sense at this stage to take a high variable rate mortgage if you can obtain a fixed rate very close to 4%. Of course, there are diehard variable rate mortgage holders. And you know what? I'm one of them. I've had a variable rate mortgage for a very long time. I wrote it up and now I'm going to ride it down. That variable rate mortgage is likely to come all the way down, maybe to that 3.6, 3.7 mark. But if you're planning on staying in your house long term and you don't need the flexibility of a variable rate mortgage, it might be the time to start considering that fixed rate mortgage in the low 4s. Take a look at this graph. You can see that analysts are expecting that we should see 7 cuts to the overnight lending rate in Canada between now and next summer. That means that bank prime should drop from 6.45 to 4.7% over the next year. If your variable rate is at prime -1, that means you might see a rate as low as 3.7 by next summer. It's important to note that when you're evaluating variable versus fixed, that these rates might actually go up in the back end of the mortgage. My view is that if variable rates get down into this 4 or 3.8, 3.7%, you might look at locking into a fixed rate at that time. Looking at this forecast curve for fixed versus variable, you can see that variable rates will drop very quickly over the next year, but fixed rates are likely to bottom out just below 4%. So when you're looking at where fixed rates are today and that 4.09%, we do think that the consideration is necessary when you're taking a mortgage if you're able to obtain that rate in the low 4s. All of these decisions are very, very difficult to make, and I don't want you to just hear it from me. This month, we've actually contracted my favorite real estate analyst, Ben Rabideau, to give us an Alberta-specific talk on all things recession, real estate, and mortgage rates. He's speaking on October 16th 16th at 10 a.m. virtually on a Zoom meeting. That is exclusive to Spire Mortgage Team clients and referral partners, and we would love to see you on that call. Ben Rabideau leads the research team at both Edge Analytics and North Cove Advisors, Canadian research firms that work exclusively with institutional investors around the world, and is considered one of the top real estate analysts in the country. I've been fortunate enough to be reading Ben's stuff for several years. I really hope that you guys are going to click that link, sign up, and join us, because this is super powerful information for anyone that is working in the real estate industry in Alberta, anyone that owns property or intends to own property in Alberta in the next couple of years, and anyone that has or needs a mortgage. We need this information so that we can make educated decisions about our financial situations. Thanks so much for listening, and see you in November.